Welcome. In today's video, I am analyzing General Insurance Corporation of India, GIC Re, which is into insurance and reinsurance business. Let us begin with the profit and loss analysis. In this video, I am not analyzing it with the peer group. It's a standalone analysis. Sales growth. From last 3 years, the sales has been growing at the rate of 35.3% CAGR compounded. Meaning from March 16, the total revenue was 15,000 crores, which increased to 37,000 crores in March 19. That's a growth rate of 35.3%, which is a very good growth rate in revenue generation. In the recent 12 trailing months, the growth has reduced to 8.1%. That is from 37,000 crores to 40,000 crores. Which is still good, considering that it is the sales is on a higher side. We don't have the data for more than 5 years. We only have data for this company from March 15 till March 19. The company has been making operating losses since since March 15 onwards till March 19. Even in the recent 12 months, it has made a operating loss of 10.7%. Most of the companies, if you look at the individual numbers in March 19, the total sales was 37,679 crores. This is the revenue generated through sales. And against that, the operating profit, or rather operating loss, was 40,928 crores. That's an expense which is more than the revenue. Since the company is into reinsurance business, if there are claims, then that it needs to settle, and that is considered under the operating activity. Even in the recent 12 months, we can see total sales are around 40,000 crores and the expenses are around 45,000 crores. So we can see that overall, since March 15 onwards itself, the company has been making operating losses. The other source of income, that is the other income, has been generating a substantial portion towards contributing a substantial portion towards the net profit. In March 19, 17.81% of the sales came through other income. That is, other income helped the company to be in positive, or net profit to be in positive. Let us look at the individual numbers. In March 19, the total sales was around 37,000 crores, against which the other income contributed 6,709 crores. We saw earlier the expenses for the company in 2019 was around 40,000 crores, whereas through other income it has generated 6,709 crores. That's a 17.81% of the sales. So most of the time this company has been earning its profits or revenue through other income source. What this company does is it collects premium from the customers or the policy holders, and then it would take that money and put it into some kind of investments, government bonds, or invest in the market to generate higher returns, or even give out loans, and thus generate some source of income for the company. So most of the income is coming from the other income. In the recent 12 months, 6,121 crores has come through the other income, over and above the revenue which was generated of 40,000 crores in the recent 12 months. That's a 15% coming from the other income. Average OPM would be again loss. The company's last 3 years on average had been making a operating loss of around 5.7%. In the last 5 years, that operating profit loss was around 6.82%. In the recent 12 months, the loss is somewhere around 10.72% of the sales. The company doesn't have any raw material cost, as it is into service business and it's not into manufacturing. Employee cost is also very low. This is a percentage of the sales, So in March 19, the employee cost was even less than 1% of the total sales. Depreciation as a percentage of total sales is also very low, meaning this company doesn't have much of the fixed assets which it needs to expense out or depreciate to the profit and loss account. It's a very minor depreciation rate being charged. So in March 19, only 14 crores came in as depreciation expenses against the sales of 37,000 crores. Interest expense is also very low since this company collects premium and doesn't have any debt on its book. Most of the premium is classified under long-term liabilities or other liabilities and is not considered as a debt or a borrowing. So interest cost is again very negligible, just 13 crores in March 19 against the total sales of 37,000 crores. This is where the company is managing to collect premium from the customers or policy holders and put that money under investments to generate income. And also the duration of that policy is very long, so the company is able to utilize that money. In March 19, company paid a tax rate of 35.2% on its profit before tax value. In the previous years, the tax rate was quite low at 11% and 13.7%. But in the recent 12 months, it seems the company's tax payment outgo is at 74% of its sales. So in the recent 12 months, the total sales done by the company, or rather the profit generated by the company in the recent 12 months is 1,753 crores. On that, the company has already paid a tax of 1,301 crores. So this is quite high. We need to understand why and what is the reason for the company to pay such amount as tax expense against the current year's profit before tax. In March 19, it was the total profit before tax was 3,400 crores, against which it paid 1,210 crores. So we can see the company's tax rate has been increasing consistently. Since the company doesn't have any borrowings or debt on its book or on its balance sheet, there is no interest outflow as we saw earlier. So interest expense as a percentage of EBIT is very high. The earnings before interest and tax in March 19 is 3,447 crores, against which the company had to pay just 13 crores as interest cost or finance cost. So the coverage would also be very high as a percentage or as a multiple of the EBIT. So against the interest paid of 13 crores, the profit generated is 3,400 crores. So that's a multiple of 271.8 times. So I'm explaining just to make you understand that what exactly is interest coverage, meaning the EBIT is easily able to pay off the interest expense of the current year. Net profit margin has been decreasing consistently from March 15, where its NPM percentage was 20.67%, and which has been steadily declining till March 19 to 5.90%, and in the recent 12 months it is dropped to 1.1%. So let us look at the values here. The total sales was around 37,000 crores in March 19, against which the company generated a profit of 2,224 crores. So that's a NPM of 5.9%. But in the recent 12 months, you can see that the sales have increased and the profit has dropped to 452 crores. So there is a worrying sign in the sense that the NPM has been dropping consistently. The average NPM from last 5 years was around 12.8%, and in the recent 3 years the NPM has decreased or declined to 8.7%, and in the recent 12 months, as we saw, the NPM was at around 1.1%. So we can see a downward trend in the average NPM also. Let's look at the growth rate in the net profit. Again, as we saw earlier, the profit has been declining, so there would be a degrowth in its net profit. So since last 3 years, that is from 16 to 19, in March 16, the total profit declared was around 2655 crore, 2655 crores, which has dropped to 2224 crores. That's a CAGR drop of 5.73% over the 3 years. We cannot calculate the 5 years degrowth rate because we don't have the 6 years data. So in the recent 12 months, the profit has dropped by 31%. That is from 2224 crores, it has fallen or declined to just 452 crores. So there is some kind of pressure or margin pressure on the company's profits, at least in the recent 12 months. Let us look at the valuation ratio, market cap to sales, meaning what was the sales generated and what was the value of the company in the market against that. So when we are looking at this ratio, it will help us understand whether we are paying a high multiple for this company or we will be able to buy at a reasonable rate or price considering what sales the company has done. So in March 2019, the price to sales or market cap to sales ratio was just 1.1 times. In fact, in March 18 also, we see it was just 1.69 times. Let's look at the value wise. So in March 19, the total market cap of the company was 42,395 crores, against which it generated a sales or got the revenue of around or generated a revenue of 37,679 crores. So that's a very good revenue generation capacity against what it is valued in the market. In March 18, the gap was quite substantial and the gap had increased to 1.69 times. Let's look at the dividend payout, that is what portion of the profit is being distributed to the shareholders. So in March 19, out of the total net profit of 2,224 crores, 1,184 was distributed to the shareholders as a dividend, or dividend of 1,184 crores was declared and paid off. So that's a 53.2% payout rate, which is very high. Even in March 18, we see a 36.62% dividend payout. So this company is not keeping any profits, or most of the profit it is earning is being distributed back to the shareholders. Many investors would want to just buy into this company because of high dividend payout. So we can see there's a consistent increase in the dividend payout from March 15 onwards. In value terms also, in March 15 the company had paid 331 crores as total dividend to the shareholders, which has now increased to 1,184 crores. Next valuation ratio is price to earning, meaning what is the multiple we are paying against the earnings of the company. So if the company has earned 100 crores in 1 year and we are paying 1,000 crores for that company, so we are paying a multiple of 10 times. So that's a price to earnings multiple. In March 19, the price earning multiple was around 19 times, and in March 18 the price was 19 times higher, again 19.9 times higher than the company's earnings per share, which translates to a price of 241 rupees in March 19, against which the company's EPS or earnings per share was just 12 rupees. That's a 19 times multiple. Again, for me, my benchmark or my criteria as such is just 25 times, meaning I have to buy below 25 times. If someone is more conservative, they can reduce the price earning multiple to 15 times. But as I see, good companies are not available below 25 times, or are very near trading to 25 times and are not available below even 15 times. So in the recent 12 months, we see a sharp rise in the price earning to 98.57. The reason for this is that the EPS has dropped to 2.58 rupees per share, whereas the price has not dropped or declined. In fact, the price has gone up from March 19 to 254 rupees. Therefore, the price to earnings has shot up to 98.5 times. Now this is expensive. Until and unless the EPS doesn't increase back up to 12 or 13, 14 rupees per share and the price doesn't drop, this becomes expensive. The average price earning since last 5 years was somewhere at around 19.5 times. In the recent 12 months we saw it shot up to 98.5 times. So at least from the average, the current price earning or the latest price earning is quite high. So in this video I'm going to analyze the individual statements of accounts like P&L, which we just did. Then we'll be analyzing balance sheet. After that we'll do cash flow analysis, and finally we will look at the quarterly profit and loss account. After that we will compare General Insurance Corporation of India with its peer group companies and understand how it compares with its group companies. So we'll begin with the equity share capital. Since March 15, the equity share capital was quite stable. In March 19, it has doubled to almost 877 crores. Now we need to understand why the equity share has got diluted, why more shares have come into the company. Return on equity, ROE, over the 5 years of data that we have, has been increasing from March 15 till March 17 to 17%. This is the profit that the company has generated on the net worth. The net worth is the equity plus the reserves or the retained earnings of the company. So on the total equity money or shareholders money, how much was the net profit? That is reflected by return on equity. So in March 19, the ROE has dropped to 9.5%. We want the ROE to be as high as possible, as that suggests to us that the company is generating a good return on shareholders' money. So in March 19, the company's net worth was at around 23,361 crores, on which it generated a net profit of 2,224 crores. So that's a return of 9.5%. As I mentioned, we want at least 15% of return on equity, but when we are looking at standalone basis, it will not give us a true picture. So we can take an average of all this and then use that as our benchmark, or else we can compare this with its peer group companies, which we will do later on. So we can see that the ROE has been dropping from 17%, which was the highest in March 17, to just 9.5% in March 19. So although the company's net worth has increased, but the profit has dropped. Next we'll look at the return on capital employed. This is the total capital employed, and total capital employed consists of the debt and the equity portion of the balance sheet. So on that total source of fund that the company has received, what was the EBIT the company managed to generate? This is the top line profit, earnings before interest and tax. So we can see that the ROCE at least is quite better than the ROE, from 6.5% in March 15 to 15.5% in March 18. In March 19, that has dropped to around 14.8%. There's some kind of pressure on the company's EBIT in March 19. So let us look at the individual values. In March 18, the total capital employed was around 22,475 crores, on which the company generated an EBIT of 3680 crores. Even in March 19, if you look on total capital employed although the capital employed has increased, the profit has decreased, or the EBIT has decreased. That is why the return on capital employed percentage has also dropped from where it was in March 18. Also, one thing to note is that in March 15, the total capital employed was around 43,000 crores, and that has substantially dropped now to 22,475 crores. So we have to understand why the net worth of the company, as we saw earlier in ROE, the equity portion of the company has dropped quite substantially from 40,000 to 18,000 crores. So this needs to be investigated as to why there is a drop in the total capital employed between March 16 to March 17. All this data is sourced from screener.in. So if there is some error, then that needs to be taken into consideration. but most of the time the data is very reliable, and we can analyze and invest on that basis. Return on assets is the profit or net profit that the company has generated on the total assets of the company or on the total balance sheet size. This is the total assets that is reflected in the balance sheet total. So we can see ROA has been dropping consistently from 3.8% to 1.9% in March 19. That's a substantial drop, and we see that although the total balance sheet size has been increasing from 73,000 crores to 1,18,000 crores, but the profit has not gone up quite substantially as the balance sheet size has gone up. So we want to see a kind of a trend in the profit. As the total balance sheet size goes up, we want the profits also to be in line with that growth rate. But we don't see this here. Let's look at the average ROE and average ROCE. Since last 3 years, the average of return on equity stood at around 13.6%, and in the last 5 years it was at 10.8%. We should ignore this 7 years because we don't have the data. So because the calculation in Excel sheet is such that it takes whatever data is available, so we just ignore this for time being. ROCE stood at around 13.4% since last 3 years on average, and in the last 5 years it was at 10.6%. As I mentioned earlier, I would want to see an ROE as well as return on capital employed of at least 15% and above. But again, we have to compare this company with its industry peer group to understand where other group companies, or what is the returns generated by other group companies on their equity and their capital employed. So then we'll get a very good basis of comparing them. Let's look at the net worth as a percentage of total assets. This is the equity plus the reserves that I mentioned earlier, and what portion of the total assets is it occupying in the balance sheet. So we want this to be as high as possible. In March 15, the net worth occupied around 59%, which has now dropped to 20% in March 19. So the balance 80% of the balance sheet size is going to the premium that the company is receiving. So the total assets as of March 19 on the company's books were around 1,18,895 crores. This is the total assets the company has shown in its balance sheet. Against that, the net worth is 23,361 crores. So that's a 20% of net worth as a percentage of total assets. So we want this to be as high as possible, but since last 3 years it is consistently at around 19 and 20%. Since the company has no borrowings, does not make sense to compare this table or graph here, so we'll skip this. But as we see, the total assets of the company has been consistently increasing from March 15 to March 19. There is no debt, so there is no comparison between debt to equity, because almost all portion of the balance sheet is in equity. From 43,000 crores in March 15, the equity portion has dropped to 23,361 crores. We should generally see an upward trend in the net worth of the company or the equity of the company, and we need to check out the reason. As I mentioned earlier, what is the reason that the equity portion has dropped or the net worth has dropped from 40,000 crores to 18,000 crores. Let us look at the valuation ratio, price to book ratio. This helps us understand how far away the price is compared to the net worth of the company, or what is the value of the company in the market against what the company is saying company is actually worth. So in March 19, the price to book ratio was at a comfortable 1.8 times. For me, my benchmark is that I should buy those companies whose price to book ratio is below 1.5, or rather 2.5 times. Anything below 2.5 times is a good buy according to me for good companies. And if someone is more conservative, then they can go till 1.5 times. That is, not buy before the price to book shows 1.5 times. So in the recent 12 months, the price to book ratio or the latest price to book is at around 1.9 times. So the market cap in March 19 stood at around 42,000 crores. This is the value of the company in the market. So someone wants to buy, they will have to pay this amount for the company. Against this market value, the company is saying that it is actually worth only 23,361 crores in on books, or in the books its price or its value being reflected is at around 23,000 crores. So the market has given it a premium to its book value. So that's a premium of around 1.8 times its actual worth or net worth. In the recent 12 months, we have to use the net worth of the 2019, and the current market cap has increased to 44,000 crores. Therefore, the price to book increases to 1.9 times. Let us look at the current ratio or the working capital requirement. So current assets or current ratio is calculated by dividing other assets or current assets by current liabilities or other liabilities. Now current means those payments, or whether to be paid or to be received, are to be cleared off in the current year. So we want the assets or the current assets to be at least equal to current liabilities or more than that. So that then we are assured that the company is in a good liquidity position to pay off the liabilities. But here we see that most of the time since March 15, its liabilities were always more than the assets it owned. From March 15 onwards, the ratio was always at 0.6 times. If you look at in March 15, the total assets of the company or other assets were at 17,588 crores, against which its liability payment was 30,357 crores. So the other assets also includes long-term as well as short-term liability. So in this particular case, we should be careful that we are looking at the current assets and not all assets of the company or all liabilities of the company. So the ratio as such has been consistent from March 15 till March 19. In March 19, the other assets of the company were at 39,000 crores, whereas the company had to pay 95,000 crores of liabilities, or the total other liabilities on its book were 95,000 crores. The reason for it being so high is because most of the premium that it receives is classified under other liabilities. The company has no assets on its book, or it is occupying a very small portion as a percentage of total assets. So we see in March 19, the total assets on the balance sheet size was at around 1,18,000 crores. Of that, only 197 crores was occupied by the assets or fixed assets of the company. So the company is very it doesn't have a lot of assets as such against what its total balance sheet sizes. Since the company is not into manufacturing and has no capital work in progress, this we can skip. The company's investment portion, earlier we saw the other income percentage. We saw that other income contributed a substantial portion of the net profit, or contributed heavily to the net profit, because most of the time the company was making operating losses. So we see here in March 15 the company's investments were very high at 76%, and this is what it needs to do. It takes policyholders' money and would invest in the market linked securities or debentures or government bonds or whatever source of investments it has with it. So that investment percentage as a percentage of total assets has been declining from 76% to 67%. The drop is not that substantial, but most of the balance sheet is in the investment portion. So we can see of the total 1,18,000 crores of the balance sheet size or total assets of the company, 79,613 crores was invested. Now if someone wants to look at what investments the company has done, then we need to look at the annual statement and go into the footnotes or the notes section to understand in much detail as to what these investments are. So throughout, if you see, throughout March 15 till March 19, most of the company's assets were always occupied or invested in some kind of investments throughout these 5 years. The company has no inventories. Again, there are no debtors as such on the company's books. This ratio also we can skip, sales to debtors, because there is no debtor, so there is no comparison as such. Debtor days also will skip. We'll look at sales to debtors also we'll have to skip because there are no debtors. Again, no inventory on the company's books. So this concludes our balance sheet analysis. Let's look at the cash flow statement. First, we'll look at how much cash has come in through operating activity. In March 15, the company showed cash earnings of 2,500 crores, which has come to 7,000 crores in March 19. So the company is earning good amount of cash from its operating activity. Of that, how much is it investing, or what is it doing with this cash that it has earned through operating? So it is investing it in, so that comes under the investing activity of the cash flow statement. So we see that the investing portion has been consistently increasing. Now this investing activity is basically consists of fixed deposits or any mutual fund investments of the company or investments in fixed assets. Ignoring the dogs barking, I'll continue my analysis because I feel most of the time very few people would come till this 33 minutes of watch time. So I'm not bothered with that. So I'll just continue with the analysis. So the company's investments has been consistently increasing, and as we saw earlier, the fixed assets of the company were very less, and investments, or rather the company's fixed assets or net block was very less, and most of the company's total assets were under investment activity. So here it makes sense to see that the company's investments have been consistently increasing. But what we need to take care of is that the investing portion should not exceed what cash the company is earning through operating activity. If the company's investing activity increases more than what it is earning in cash, that means the company is borrowing more money to fund its investing activity. So this is good, this is okay, because in March 19 the company had earned 7,000 crores. Of that 6,900 crores has been invested. Let's look at how much came in or went into financing activity. So here also we see from March 15 till March 19, the company's outflow in terms of cash in financing activity has been steadily increasing from 387 crores to 1,428 crores. So here too we want to, because we saw earlier in the dividend payout, a major portion of the net profit was distributed to the shareholders as dividend. So the dividend portion comes under the financing activity. So we see that the payout in financing activity has been steadily increasing. The negative means that there is an outflow, and positive means there is an inflow of cash. Finally, we look at the net cash flow after taking all these three activities: operating, investing and financing. What is the net cash inflow or outflow in 2019? So the company had to pay out an additional 1,324 crores, or additional 1,324 crores went out of the company's books or balance sheet. So we generally want some kind of net cash flow coming into the business, or being positive at least. This is an important ratio to compare the profit before tax with the cash flow from operations. This ratio then helps us understand whatever profit the company has declared, what portion of that profit is the company receiving in cash, or how much of that profit the company has declared is actually getting converted into cash. So we want most of the PBT or profit before tax to be converted to cash flow from operations. So we see in the last 3 years, the company has declared a total profit before tax of 10,726 crores. Against that, the company has received cash of 23,460 crores. So this is a very good cash receivable against the profit declared. So that's it, 219% more cash coming in against the profit declared. So in the last 5 years, we see that the company's PBT or profit before tax was 16,543 crores, against which it received 192% more in terms of cash. So the cash coming in was around 31,833 crores. So we should always want that the company's cash coming in through operations be more than the PBT or profit before tax. We'll also need to cross-check this with its peer group companies, how the other group companies are translating its PBT into cash. We'll also look at how much of that cash from operations that we saw earlier, how much is being invested in the investing activity part. So we see that 71% of whatever cash the company had earned in the last 3 years was invested back into the business in terms of investing activity basically. And even in last 5 years, it was at 71%. So out of the 31,000 crores of cash earned in the last 5 years, 22,000 was invested in the investing activity. That is, mostly it should have been invested or gone into buying of bonds or some kind of investing activity basically. So that's a 71% throughout in the last 5 years as well as in the last 3 years. That concludes our cash flow statement analysis. Let's move on to the quarterly P&L account analysis. Let's begin by looking at the sales growth YOY and quarter on quarter as well as profit growth rate. So sales from September to September quarter has grown by 8.2%. We would want the sales to at least grow every year or rather quarter on quarter. Even though the profit may decline, we would want that the sales be growing because that shows that the company is generating revenue consistently. But in quarter on quarter analysis, that is from June 2019 to September 2019, we have seen a fall of around 28% in the total sales. That is, sales have declined by 28% from its previous quarter. And from September 2018 to September 2019, that has gone up by 8.2%. So YOY is more important than the QOQ analysis. In terms of profit, we see that YOY or year on year, the profit has declined by 215%. So although the sales have gone up, the profit has dropped quite substantially at a very high margin of 215.9%. So whenever we see such a kind of a percentage figure, we should cross-check with the actual values rather than depend on the percentage. Generally, we should not see such a high percentage drop year on year, and if we do, then we need to look at the individual values of September 2018 and September 2019 profits. Quarter on quarter also, it has gone down by 648%. So as I mentioned, a very high value should be investigated separately by looking at individual numbers. So as of now, we see that there is a margin pressure or pressure on the profit figure. And we have, when we analyze the P&L account also, we saw that the profit had declined substantially from year on in the recent 12 months from where it was in March 2019. Let's look at the net profit margin in terms of quarterly analysis. So in September, the NPM was at around 4.7%. In March 19, we saw a good uprise or increase in the NPM of 11.9%. But in June, the net profit margin declined to 0.6. And in September quarter, we see a net loss margin. That is, the company has suffered losses of around 5% on its sales in the September quarter. Let's look at the individual values of September 19. We see that against the total sales of 11,900 crores, the company had made a loss of 595 crores. So we see that although consistently from September 2018, it has managed up till March 19 a profit or positive value in the net profit. In June 19, the profit has dropped. Although the sales have increased, the profit has dropped quite substantially. And finally, in September 19, it has shown losses. So then, when the company's long-term outlook is good, we can ignore the short-term problems in the company and assume that the company would be able to come out of that issues or whatever it is facing, whether it is the general market sentiment or the sector sentiment, or specifically related with the sector in which the company is. So when there is a specific problem with the company rather than sector, then that is a problem that needs to be investigated, and we should mostly would want to get out if it's company specific problem. So this loss also needs to be investigated separately. What this loss is it a one-time exceptional loss? Sometimes the company would sell at a loss or do some write-offs, and that write-offs gets reflected in the net loss of the company. So that needs to be understood if this is a one-time loss or it is a loss which is there because of the overall sentiment on the company. So this concludes my analysis of the statements or financial statements of the company, and in the next part I'll look at the peer group analysis and we will give it a score as well and see which companies have done well in that sense. Till then, goodbye.